All right, guys, it's about time we talk about the relatively new income ETF that pays monthly, has pretty minimal volatility, and keeps growing more and more popular every single month. Now, the ETF I'm talking about is JEPI, or the JP Morgan Equity Premium Income ETF. This new ETF came out in May of 2020 and has grown to just under $7 million in assets under management in that short time. So in today's video, we're going to talk about this ETF, we're going to go over its objectives, we're going to look at its performance, even though that's pretty short, and also, do remember, past performance does not guarantee future performance. After that, I'm going to give my personal opinion on this ETF, who it's a good fit for, am I investing in it currently, and also what I think might be better options for the majority of people. Now, I will say I'm not a financial advisor, and this video is not financial advice. It's up to you guys to do your own research before you make any investment decisions. That being said, if you're new to the channel, my name is Matthew Muniz. I do weekly videos on anything related to fitness or personal finance. So if you want to live longer, make your money go further, be able to spend quality time with your family and friends, make sure you smash the like button down below, subscribe to the channel. We do videos every Thursday. With that being said, let's get into the video. So what is the objective of JEPI? Well, as most people like to call it, Jeppy. Jeppy seeks to deliver monthly distributed income and equity market exposure with less volatility. So in other words, basically they want to pay you monthly and they want to have minimal volatility while replicating the results of the S&P 500. So how does Jeppy accomplish this objective? Well, Jeppy is actively managed with an expense ratio of 0.35%. That's $35 per $10,000 invested. This is actually a pretty modest expense ratio when you compare it to other income ETFs such as Q Yield or NUSI. Now, in terms of the volatility, it does not have the protection such as something like NUSI because it does not have downside protection in the form of puts. However, because the fund managers invest in large cap stocks that have minimal volatility and we're collecting monthly premiums from covered calls, we do have a little bit of downside protection just by the fact that we're still getting paid even when the market does go down. However, it does not have crash protection. Now, that may be seen as a benefit. However, as with all covered call ETFs, when you sell covered calls, just by the nature of this, you limit your upside potential. So that can be seen as a downside by many people. Now, when we look at the trailing 12-month dividend yield, it's just under 7%, which is pretty strong. However, it's not as high as, for instance, the S&P 500 covered call ETF X yield. But do note that these have different strategies. Now let's take a look at the actual assets that the fund holds because it's not just S&P 500 stocks. So when we look at the holdings for Jeppy, realize that 80% of the holdings are going to be equities, typically large cap like I mentioned before, and then 20% are going to be ELNs or equity linked notes. Now equity linked notes are pretty confusing and complex, so I'm not going to explain them. However, all you need to know is that that is how the company does their covered call options. So that's how they generate that extra monthly income and have a higher return than your typical dividends paid from these companies. If you look through here, you're going to see some stocks that you definitely know: Microsoft, Coca-Cola, Alphabet, Hershey. These are really long-term, strong companies that have that minimal volatility. And also, in addition to that, what JP Morgan does to help reduce the volatility as well is they choose companies that integrate ESG, or environmental, social, and governance factors. And the reason for that is long-term, things are going to change, regulations are going to change over time, and they are hoping that over time, these stocks need to change minimally in order to meet those new regulations. They're not going to be exposed to as much risk as something like ExxonMobil, for instance. So now that we've talked about the theory of how the fund's supposed to work and how it's going to accomplish those objectives, how is it actually done? Let's look at its history, which I told you is pretty short, and see how it compares to the S&P 500, since that's what it's trying to compare itself to. Let's take a look. So now what I've done here with this spreadsheet is I'm comparing Jeppy, which is in the blue, to the yellow, which is VOO, the Vanguard ETF that mimics the S&P 500. Now, obviously you see a beginning here, but we're going to ignore that. We're only going to talk about since the inception of the fund. So it started off at $50 and it ended up being around $60, a 20% growth. However, look at the difference just in capital appreciation of the S&P 500, a massive difference. Now, if we go down to 1 year, it's a lot less. It's not quite as drastic, but you can really see when we look at the 5 year, the difference in overall volatility. So in terms of dips and price change, you're not going down quite as much, but you're also not going up quite as much. So in general, it definitely meets the volatility aspect, but it does not do a good job in terms of just capital appreciation when comparing to the S&P 500. However, if we talk about when we reinvest the dividends, because it has a really good dividend of around 7 to 8%, we can look at that, and we have a lot closer results here. If we had started at the inception with a $10,000 investment, at the ending on March 1st, 2022, we would have had just under 15,000 with the S&P 500 versus a little over 13,000. So obviously it's not as good, but you have to remember the idea of Jeppy is also to provide consistent monthly income. And anytime that you're doing those covered calls, you're going to get that monthly income and it's going to be a good yield. However, you are limiting the upside potential. And we can clearly see that by looking at this data. Now, we do know that past results don't guarantee future results. So things could change moving forward. However, I think this is an accurate representation of what we're going to see moving forward for Jeppy. So what is my personal opinion on Jeppy? Well, I think it's a good fund, but for me, it doesn't fit what I'm looking to do. Now, I am pretty far from retirement. I'm about 20 to 25 years from retiring. So I'm not looking for monthly income that I have to pay taxes on at the end of the year. I do like strong dividends. I think one thing that people forget to mention is the psychological aspect of investing, where when you can see yourself getting paid monthly, it helps you to be a little bit more frugal, keep investing more money into your dividend ETFs so that you can keep collecting higher paychecks. You know, getting paid to do nothing is awesome, especially in a down market. Right now, my portfolio is pretty red. However, I'm still getting paid monthly for my dividend ETFs. So if you're close to retirement or you're already in retirement, I think Jeppy is a great addition to help diversify your portfolio in terms of still providing a great yield and having a little bit lower volatility than something else. So a lot of people, if you go on like Reddit, talk about the quadfecta: Q Yield, Nusi, Devo, and Jeppy. Ultimate combo, works fantastic. I think if you're in that boat, then it's going to be a good option for you. Personally, in terms of dividend ETFs, I invest in Devo. I like that one a little bit better. And I think in a future video, I'm going to compare the two and tell you why I like Devo more. But in short, Devo focuses more on dividend growth ETFs, whereas Jeppy doesn't really focus on that. They focus just on large cap stocks, which is fine, but you know. So all in all, yes, Jeppy is a great tool to a portfolio if you're looking for diversification, and I think it does a good job at meeting its objective. So if that's for you, then it's probably a good addition. Now, I want to know from you guys, what do you think about from Jeppy? If you're still watching the video, leave me a comment down below. Let me know what you thought, and I hope to see you guys in the next one. Take care.